Bitcoin, Ethereum, blockchain, you've probably heard these words thrown around a lot, right? They're everywhere, promising to totally change the world of finance. But what do they actually mean? Well, let's pull back the curtain, and in the next few minutes, we're going to demystify what cryptocurrency is all about.
To really get your head around this, you have to start with one big, kind of radical question. What if money wasn't controlled by banks or governments? Seriously, imagine no central authority issuing it. No big financial companies needed to process your payments. That is the core idea that kicked off this whole crypto revolution.
All right, so what exactly is it? At its heart, cryptocurrency is just digital money. The crypto part is key. It comes from cryptography, which is basically the super complex encoding that makes it secure and almost impossible to fake. And here's the real game changer. It's decentralized. That means no single company, no government, nobody is in charge. Now, this is completely different from the money we use every day. You know, the dollars or euros in your wallet, which are called fiat currency. That stuff is controlled by central banks. Crypto, on the other hand, runs on a peer-to-peer network. That just means you can send it directly to someone else, completely cutting out the middlemen, like a bank or a credit card company. So you're probably wondering, how on earth is that possible? How can a system work securely if there's no bank in the middle to verify everything? Well, the answer is this incredible technology called the blockchain. It's the engine that makes it all run. The easiest way to picture the blockchain is to think of a giant shared digital spreadsheet. Every single transaction that ever happens gets recorded on it. But, and this is the crucial part, instead of that spreadsheet being stored on one bank's private server, it's copied and spread out across thousands of computers all over the world. This makes it public, transparent, and incredibly difficult for anyone to mess with. Okay, let's walk through what actually happens. Let's say Alice wants to send some crypto to Bob. Her request gets bundled up with a bunch of other transactions into a block. That block then gets turned into a super complex math puzzle. Computers on the network, called miners, all race to solve this puzzle. The first one to crack the code gets to add the new block to the chain, and for their work, they get a reward of brand new crypto. Once that block is added, the transaction is officially verified and Bob gets his funds. That whole competitive process is what keeps the system secure without needing a bank. So now that we've got a handle on the technology, you need to know that not all crypto is the same. When most people hear crypto, their mind immediately jumps to Bitcoin. But honestly, that's just the tip of the iceberg. The crypto universe is huge and really diverse. Different cryptocurrencies are built to do totally different things. You've got your transactional coins like Bitcoin, which were designed purely to be a new form of payment. Then you have platform coins like Ethereum, which act more like an operating system for building new kinds of applications. There are also utility tokens like XRP, made for one specific job. And finally, you have stablecoins like USDC, which are tied to something stable like the US dollar to avoid all those wild price swings. As you can imagine, all this new tech has sparked a massive debate. People are really divided. Is cryptocurrency a revolutionary force for good, or is it just opening a Pandora's box of new problems for us? And the debate really comes down to this. On one side, you have people excited about cheaper, faster global payments and getting away from the power of big banks. But on the other side, critics are quick to point out the insane price volatility, the massive amount of energy that mining uses, and of course, its use in illegal activities. And when we say volatility, we mean it. Just to give you a picture, the price of a single Bitcoin has rocketed up to nearly $70,000 and then plummeted down to around $20,000, all in a pretty short time frame. I mean, that's the definition of a roller coaster ride, and it's what makes crypto such a high-risk game. Now, another thing we need to clear up is this idea that crypto is totally anonymous. It's actually not. The better word is pseudonymous. So while your real name isn't attached to a transaction, every single payment leaves a permanent digital footprint on the blockchain. It's a trail that investigators can and absolutely do follow. Okay, so with this whole complicated picture in mind, the good, the bad, and the confusing, what are the real-world things you need to think about before ever getting involved? The risks here are no joke. On top of the wild price swings, governments are still trying to figure out the rules, so the regulations are constantly changing. Then you have huge security risks. If a crypto exchange gets hacked, or you just lose your password, which is called a private key, your funds could be gone. Forever. And unlike the money in your bank, there's no FDIC insurance to protect you. There's no safety net. And here's a really important one that a lot of people miss: taxes. In the US, the IRS doesn't see crypto as currency, it sees it as property. That means if you sell it for a profit, you owe capital gains tax. But it also means that just using your crypto to buy something can trigger a taxable event if its value went up since you first got it. This all brings us back to a really basic but important question. When you consider the volatility, the risks, the tax complexity, can we even really call cryptocurrency money in the way we normally think about it? Well, economists usually say something has to do three things to be considered money. It has to be a widespread means of payment, a stable store of value, and a common unit of account. Traditional money, like the dollar, checks all those boxes. But right now, crypto kind of struggles. Its acceptance as payment is still pretty limited, and as we saw, its volatility makes it a really poor store of value. So here's the bottom line, the key takeaway from all this. The technology behind crypto, the blockchain, is absolutely groundbreaking, no doubt about it. But for now, cryptocurrency itself is best seen as a highly speculative and very volatile asset class. It has enormous potential for sure, but it also comes with huge risks and a ton of uncertainty. And all of that leaves us with the million-dollar question, the one that everyone from regular investors to entire governments is trying to figure out. Is this the very beginning of the future of finance, or are we just watching one of the biggest speculative bubbles in history? Honestly, the final chapter of that story is still being written.